The markets have been buzzing after Powell's Jackson Hole speech, and traders everywhere are asking the same thing. What does this mean for gold, Bitcoin, and the broader market in the days ahead? What's up YouTube, Julian here, and in this video, I'm going to be breaking down Powell's latest comments, how the market reacted, and more importantly, what can we expect next for gold and Bitcoin. I'm going to walk through some of the key levels that I'm watching, sharing how I'm positioning myself as we move into the week. So grab your charts, pay close attention, and let's dive right in. As you guys can see, I'm not in my usual studio, but I'm still here to share with you what my thoughts are approaching the new week after the Jackson Hole Symposium. Now, if you like videos like this, I'm going to give you 5 seconds. Help me out by clicking subscribe and also commenting more so that I can produce more videos like this for you guys. 5, 4, 3, 2, 1. Without further ado, let's get back into the video. So as you guys may have heard, the Jackson Hole Symposium, Powell actually signaled that there may be interest rate cuts as early as September. And this is something we've been expecting already, pointing to the shifting balance of risks, including the signs of labor market deterioration and lingering tariff pressures. Here's what he said.
While the labor market appears to be in balance, it is a curious kind of balance that results from a marked slowing in both the supply of and demand for workers. This unusual situation suggests that downside risks to employment are rising. Putting the pieces together, what are the implications for monetary policy? In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. When our goals are in tension like this, our framework calls for us to balance both sides of our dual mandate. Our policy rate is now 100 basis points closer to neutral than it was a year ago, and the stability of the unemployment rate and other labor market measures allows us to proceed carefully as we consider changes to our policy stance.
He also flagged a slowdown in the labor market. Both the supply and demand for workers are weakening, raising risk of layoffs if the conditions worsen. This is seen in the recent July report that only 73,000 jobs were added, and job growth were averaging at 35,000 jobs a month over the last 3 months, indicating that hiring has stagnated. On inflation, Powell acknowledged that tariffs are pushing prices higher, but suggested that these effects might be even temporary, even though inflation still sits above the Federal Reserve's 2% target. And more importantly, the Federal Reserve is moving away from its old FAIT framework and shifting towards a more data-driven, preemptive approach. Now, Julian, you may be asking me, what is this FAIT? Let me just quickly explain what this framework is all about in just simple terms. So imagine that inflation is just like you driving on a highway with a speed limit of 60 kilometers per hour. Now, before the Federal Reserve's rule, it was actually very simple. If you drive too fast, then you just need to slow down. If you drive too slow, then you need to speed up. But under the FAIT, the Federal Reserve is now saying that it's okay if you go faster than 60 kilometers per hour for a while, as long as before that you were driving slower. So in the sense, it kind of averages out. Now the problem here is this. Inflation just didn't go above 70 kilometers an hour for a short stretch. It actually shot up to 100 kilometers per hour and stayed there for some time. And by the time the Federal Reserve actually hit the brakes, the car was already spinning out of control. Boom! So that's why Jerome Powell is now saying, forget the averaging. We'll just adjust the speed in real time to keep things under control. So the question is, how did the market react to this? Markets wasted no time reacting, because what happened? Immediately after his speech, the stocks rallied. The S&P 500 gained about 1.3%. The Dow Jones jumped big. Treasury yields dropped tremendously. The rate cut bets soared, and traders now price in a 91% chance of a September cut, with just about 50 basis points of easing expected by the year end. Gold and Bitcoin rallied. Spot gold rose about 1.7% and Bitcoin climbed roughly about 5%. So Julian, how does this impact gold? Let's talk about gold for a little bit. Jerome Powell's dovish speech is clearly bullish for gold. So in the short term, I will see that lower interest rates will weaken the dollar, making gold more attractive since it doesn't pay interest. And in the coming weeks, I want to see gold break past the 3,400 key level to head on higher to the next weekly resistance of 3,440. If it's able to break these two levels, I can very well see gold potentially breaking the all-time highs. And this is definitely possible. If the inflation sticks around while the interest rate stays low, gold will continue to shine as a hedge. So how about Bitcoin? For Bitcoin, it tends to move like a risk asset, which is a hedge. So it has high potential to rally along with stocks on the easing sentiment. And with Bitcoin being the digital gold, I see a possibility of it heading higher due to more liquidity and inflation risk. However, looking at it at a technical perspective, I want it to break past the all-time highs. I want to see a weekly solid body candle close above the weekly resistance of 119,600. So in other words, Jerome Powell's signal is a win for crypto traders too. So this is my take on Jerome Powell's Jackson Hole update and what it means for gold and Bitcoin this week. And if you found this breakdown to be helpful, help me out, drop a like, subscribe for more market insights, and let me know in the comments, are you bullish on gold and Bitcoin or both as the Federal Reserve gears up for more rate cuts? And if you want to see how I was able to do a 200 pip move trading gold live, then just watch the video around this and I'll catch you in the next video. Bye bye.